I just wonder from your perspective how you think market participants will respond to headlines like that through the winter.
Well, I think if it spreads, obviously it's going to be negative. And look, you can talk about, if you're going to talk about that, John, then you have to talk about the U.S. The U.S. has done the worst job of controlling COVID, has the inability to add to fiscal stimulus, as we've seen. And this has tremendous political dysfunction and risk building into it over the next 3 months. So part of this is a relative opportunity. We think Europe has none of that political risk. We don't think the second wave is going to build. We do think rapid testing is imminent and is on the ground in the UK and in Germany. We expect more of that. And so we think this is an opportunity to build, particularly in markets like Germany, which we favor, as well as in the banks, which we've talked about quite a bit. And I think the opportunity here is significant in the banks. And I can give you a 2-for-1, good news, bad news, if you're up for it.
I'm up for it, Jay. Go on.
Okay, so the bad news last week was pretty clear. You had the China unreliable list, which smacked HSBC. You had the concerns about money laundering and the questions over dividends. All that smashed the European banks lower. On the other side of things, you have an M&A wave taking place in Italy, in Spain, possibly in Switzerland, next cross-border. You have banks cutting branches, German banks cutting branches 20%. You have provisioning peaked. You have credit growth, 5% year over year. You have incredibly cheap banks at 0.5 times book. They're completely under-owned. So to me, again, it's all a question of balance, of upside, downside. I think the European banks here are screaming by, and I would not be surprised at all if we are able to sustain that global recovery, which Europe is a big part of. Then I believe we will see significantly higher prices in the next 6 to 12 months.